So today, Sandro is going to do his top 10 financial tips, and we're going to start. I think we've got 10 links over the 2-hour show, so we're going to try and do one in each one, if that's all right, Sandro.
This radio show is not thrown together, is it, Paul? 10 tips, 10 links. I'm very, very impressed.
Oh, it's just the hand of God. Call me Diego.
Well, you've justified the jingle. That's all I can say.
Right. So, what is your number one tip? Is this your number one tip, or just one of 10?
Oh, one of 10. I wouldn't necessarily have them in an order. But just to put this into perspective, I've been in the financial services business, Paul, for 31 years, man and boy.
I know it tells.
Thank you. And I've aged considerably in the time we've known each other. And one of the common misperceptions I have all the time, which leads to tip number one, which is, I wouldn't say the most important, but it's one that will resonate with all the listeners out there. And that is the people who make decisions based on emotion rather than logic. And no better time to give you an example of what I'm talking about with inflation rising and stock markets falling, commodity prices all over the place. People tend to, it's called the principle of consensus. What tends to happen is that people make decisions using the right side of their brain, which is the emotional side. They look at what other people are doing. They see people making money, so they buy, they copy. And then equally, when things aren't going so well, they tend to react and they sell because they see other people losing money or their assets depreciate in value. Actually, for reasons we'll come on to talk about in the other 9 tips, that's probably the wrong way around to do it, obviously, because what tends to happen is that we need to get to a level of confidence that brings us to a point where we want to buy something, by which time the price has risen to a point where it's not very, there's not much value there. And conversely, we tend to wait too long before we take action to sell, which means that we are probably selling at a very, very low price. So very, very easy way to lose money, Paul, particularly in the long term, is to sell when everyone else is selling and buy when everyone else is buying, which sounds counterintuitive, but actually the people who make money tend to do the opposite of what most people do.
Yeah, so I guess one good example of emotional thinking or behaviour would be chasing losses.
Absolutely, and you see that lots of different examples from one end of the spectrum, people in casinos doubling up, trying to win their losses back. But it happens every day, whether it's an ISA, individual savings account, or property, or, money in the bank. It doesn't really matter what kind of asset. People do tend to try to make good the poor financial decisions they've made, but they are largely speaking based on emotion, and that's the wrong way to approach it generally.
So what is the best way? How do you educate yourself not to make emotional decisions?
Well, that's tough, obviously, but getting great advice from Aspen Waite, from
or you
or me.
Yeah.
I wasn't there. I wasn't looking for a commercial plug there, but no, I mean, wheresoever you get that information, whether it's just reading up on a subject, but graphs and charts. Look, I'll give you an example. Look at the stock market at the moment. People are saying not a place to be. It's very volatile, and there's this terrible conflict going on in the Ukraine that everybody knows about, of course. And that, of course, has an impact on world stock markets in lots of different assets as well. But the fact of the matter is that there is opportunity when there are challenges in a particular market or asset class. And most great property developers over the years that have bought and sold property have tended to buy property when everyone else is selling them, because back in the stock market crash and the periods of recession in the late 90s and 2008, 2009, which everyone knows about, that's when most people make money, because they're buying when everyone else is selling.
Yeah, that's what marks out the entrepreneur from the crowd.
There's a reason why 3% of the world's population employ the other 97%, Paul.
So, welcome back to the second tip of Sandro for today. So, what is the second tip, Sandro?
Well, I have to say, that was a good start music-wise, Paul. I'm all credit to you for those 2 choices. So, thank you for that. Takes me back to the 80s. Second tip today,
You're not going to
Paul.
start dancing, are you?
No. And after your comment earlier on, I'm not even going to attempt to sing them either.
Okay, good.
So education is power. That's the second one. And I'll give you an example. In my world, when I talk to a new prospective client, one of the things that I always do, Paul, is I always produce a report. So we meet, I gather information, find out a little bit about them, what they aspire to do financially. And then I will send them a report, and that report will generally encompass 3 things. It will have their personal information that they've given me, their financial objectives, and then a whole series of outline observations. And the reason for that, which many financial professionals don't do, is to help empower them to make choices and decisions. And what I mean by that is, all too often, and you know this in your professional world, Paul, you tend to have accountants, solicitors, financial advisors, and lots of other professionals as well, who will say, Paul, do this, Paul, do that. And you will instinctively say, well, he must know what he's talking about. He's been around for long enough. I'll kind of follow the advice, which is fine to a point. But what tends to happen after 12 months, let's take that as an example, you inevitably get the family member who sits down with all these papers that they've amassed, having followed your good advice all that time ago, and then start to get really uncomfortable because they don't understand what they've done and why they've done it. So the empowerment, which is knowledge based, so that's either, get a good advisor, read up on a subject, do as much research as you can, or just get a basic understanding without having to go into too much detail, but a basic understanding that makes you feel comfortable with the decisions you made. So why are you making them? For what purpose? What financial objective does it link to? And once you become comfortable through a level of understanding, you are much more likely to stick to the plan. We'll come on to talk about longevity of the decisions that we make, because that's another very important factor in achieving financial success. So education is power is a very, very important part of the process, which way too many people overlook.
I don't know. Obviously, I don't know what your 10 tips are, but one of the things which probably also covered your emotional point is I'm a great believer in the fact if you're going to have an advisor, you should be advised. It's amazing how many people will say to you, I went to the pub last night, and they'll tell you 10 different opinions about whether they should buy a car on contract hire or lease or something, or something on pensions, So I think that's quite interesting.
So at the moment, again, I get a lot of people who say, I've got some cash and I've got, let's say, a buy-to-let property. I've got a mortgage on my buy-to-let property. Paul, should I use the cash to pay off the mortgage, or should I keep the cash, invest it, and try to make more than the cost of the debt? Now, broadly speaking, half of the population will take the decision to repay the debt because they're naturally quite cautious. Others will take their chances by investing the money, hoping to make more in investment returns than the cost of the debt, and thus make a profit. It actually doesn't matter which one of the 2 sides of the fence you sit on, because there is no right and is no wrong. The important point I'm trying to make here is, as long as you understand the reasons why you've made one decision or the other, in other words, there are pros and cons to both. If you understand the pros and the cons of both, you are more likely to make an empowered, logical decision, and therefore it's much more likely to be the right one.
I think that's true of just about anything in life, isn't it?
It is.
Yes. So, is that your second tip over?
Well, I'll go on talking as long as you want me to, but that, broadly speaking, we could go into a lot more detail, Paul, obviously, but that is a really good place to start. Understanding the whys, the wherefores, the advantages and the disadvantages, and once you get a basic grip, without having to be, you don't need a BA in financial planning to make these decisions for yourself, but you do need to understand why you're doing them.
Yeah, I think one of the things I was thinking about when I was listening to you is one of the problems with a lot of advisors is they have what I would call mono-tracked advice. Like, one set of advice fits all. And I think one of the things that you and I are both very good at is we recognise that everyone's different. I think that's very important, don't you?
Very, very important, yeah.
So we're on to tip number 3.
Tip number 3. This is a big one, actually. And let's just call it maintaining liquidity. And what we mean by that is that in order to be tax efficient, in order to be fluid, in order to be flexible, it's always good to have cash. Now, coming from somebody who specializes in investments and tax planning, that almost sounds like a contradiction in terms. But as a general rule, in fact, it's golden rule number 1 whenever you come to invest any kind of money or put any kind of financial plan together, you should always have what I call an emergency fund. So that is the money sitting on deposit, as we know, earning absolutely nothing in the way of interest at the moment. But although in the long term, holding too much cash is damaging, because obviously the effects of inflation mean that the real buying power of that money will reduce over time. A loaf of bread doesn't cost today what it did in 1980, for example. The reality is that between 3 and 6 months expenditure should always be kept as a safety net. So if the roof blows off the house, the wheels fall off the car, or you suddenly decide on a whim that you're going to spend all your furlough money and go on a holiday with your family, You don't leave
Political joke.
I know. But you don't leave yourself in a situation where you have to go to assets and start selling them in order to be able to realise the cash you need to cover those short-term emergencies. There is a caveat to that. Although we say 3 to 6 months expenditure is a good place to start, some people, for whatever reason, just say, I just like a number. It's 10,000, it's 20,000, it's whatever makes you feel instinctively comfortable. But having liquidity is very, very, very important. Despite what people say about the fact that you're not making returns on cash, it's a very, very important mainstay of any financial plan.
Yeah, I'll tell you something. You and I come from similar backgrounds, i.e. self-made people that have never been given anything. I think one of the things that's quite interesting, which people don't tend to talk about, but I don't mind admitting it, is I find with myself that having come from a background of having no money, and it's quite ridiculous. I actually was saying to my chums the other day that we actually had as much borrowing 10 years ago when our turnover was a quarter the size than we do today. So in theory, today should be very relaxing. But I find that with myself that I don't think there is actually an amount of money that actually makes me feel safe. Do you know what I mean? It's almost like when you've had nothing and you've suddenly got it, the fear of losing what you've got is actually greater than when you had nothing, if that makes sense.
It does. And what you're talking about there, Paul, is something we call gearing, which is you borrowing somebody else's money at hopefully a fairly low rate of interest in order to make that money go to work for you in the hope that you make a greater return than the cost of the debt. It's a bit like the point I made earlier. But overriding that, the overarching thing here is that if you want to go and buy an asset, let's say a property for £100,000, you wouldn't go and spend the £100,000 you've got in the bank on buying that property and leave yourself with no cash. You'd borrow, let's say, £50,000 in order to be able to keep £50,000 of liquidity so that if there was a sudden change in the wind direction or the world changed, as we've seen happen fairly recently, and you needed to lay your hands on some cash for business cash flow purposes to keep the family going, somebody gets made redundant in the family, those kinds of events, you are then covered rather than have to go back to the mortgage lender and say, oh, by the way, we didn't mean to pay off the whole of that mortgage. Can we have some of it back, please?
Yeah, I think a sort of a crude analogy I'd give for that is a bit like when I go to the horse racing, which I like very much, and I'm a great believer that you should only bet what you can afford to lose, and I think the same thing applies to investments. One thing I would say, which might seem contrary to how probably people see me as a person, is I always think that if there's a line between over-prudent and the other way around, that I would always walk to the side of prudence. I always think a prudent man will survive a recession, whereas perhaps a more risk-taking person wouldn't. Do you agree with that?
I do, absolutely. I think most of us are built towards caution when things get difficult. There is a tendency... I find very few people over the last 31 years have tended to swim against a tide. If they see a recession looming, most people naturally will move towards risk-averse assets, quite understandably. So I think we always have that fight or flight thing within us. Very, very few people I've ever come across will be irresponsible when it comes to investing. So I would agree with that 100%.
So welcome back to the fourth part of our Financial Forte show today with the man who invented ice cream himself and hotels.
Oh, I wish.
Yeah.
I wish.
To go to Burnham-on-Sea, still got Forte's ice cream parlour.
I do.
Named after one of your ancestors.
Absolutely.
Was it auntie or something, or uncle? Or
cousins, yeah.
Cousins, mm-hmm. Yeah, very good. So what's tip number 4 then, Sandro?
Tip number 4, Paul, would be diversify. I mean, this is a small word that means has big connotations. And by diversification, what we're talking about here is, and to your earlier point, which was a very good one, most people, if you give them an option to make lots and lots of money, I mean, everybody in an ideal world wants to make lots of money with the minimum possible risk. But when you explain that, in order to make more, you have to risk more, because the two things go hand in hand, most people will generally settle for consistent returns without too much volatility. And by volatility, we mean the journey that money goes on, in terms of, the ups and downs of its performance. So by diversifying, what you tend to find is that you stand a much greater chance of getting good, consistent returns without too much fluctuation, because fluctuation is the thing that causes sleepless nights. It's great when you can report that you've just made 10% on the value of something, but equally, if you open a statement one day and you see that the value of your investment's gone down by 10%, that presents a whole different emotional set of problems. So diversification generally involves a very, very broadly spread set of investments, whether that's property, bricks and mortar, nice safe haven over the last 20, 30, 50 years, cash, as we've already discussed, stocks and shares. Now, some people say, well, I'm not really into the stock market. I don't really want to take risk. But one thing that I try to educate people about, Paul, is that you can have a very diversified portfolio that includes quite risky investments. So if we take a stock or a share as a fairly risky investment, but we counterbalance that with cash, you can still end up with a fairly diversified portfolio.
But I guess to some extent, the pension fund does invest in stocks, doesn't it? So everyone, even if they realise it, is investing in the stock market.
They are. And whether you are looking to invest personally, moving money around yourself, making those investment decisions, or handing that responsibility to a fund manager in a pension fund, for example. But yes, you're right. A fund manager is going to be focused very much on getting a good, consistent return. I mean, if you can make 7% a year on your investments, Paul, you'll double your money every 10.2 years. Quite an interesting stat, isn't it?
Yeah, it is, yeah. Do you think returns are going to be affected by the world's position at the moment with the Ukraine, etc., commodity prices obviously shooting up, lack of grain, this sort of thing, obviously general uncertainty in the world?
Well, we talk about oil prices. Nickel, just over a week ago, more than doubled in price overnight. I mean, extraordinary growth. And then followed by a fairly enormous fall. So, we know that even commodities that a lot of people look at, and commodities, for those listening who don't know what one is, don't wish to be patronising,
Watch trading places.
Yeah, raw materials that can be bought and sold, basically. So that would be
orange
things
juice.
like, orange juice, copper, zinc, as we've discussed before. So, these things do fluctuate in value, but there are opportunities in any marketplace. So the answer to your question is yes, undoubtedly. But as we've seen from every other major correction or adjustment in the stock market caused by everything from, 9/11, the Korean War, the stock market crisis of 2008, 2009, the market is extremely resilient. And what you notice, if you look at all the charts that track performance, the markets tend to recover very quickly. On average, it takes about 4 months throughout history for markets to recover their position. So that's pretty extraordinary.
So, Sandro, what is tip number 5 as we approach the end of our first hour?
Let me have a think. The gentlest of all of them. Probably.
You don't have to.
No, I know, I was joking. Probably, Paul, price versus value. It's a conundrum that a lot of people have. They don't really properly understand it. So hopefully I'll dispel a couple of misconceptions here. So what we're talking about here, Paul, is a lot of people, there are lots of good examples, some geographically not very far away from us, that run big financial institutions. And what they do is they offer products and solutions at a very low, inverted commas, price. And there's absolutely nothing wrong with low prices, obviously, because the lower that something is priced at, the more chance it has of growing because it's not being burdened with excessive charges, for example. But the thing is, and I'll try and put this in very simple terms, if you've got an asset that takes, a 1% cost to manage, we normally refer to it as annual management charge. If it costs 1% and the return on that investment is 5%, then you're paying 1%, that's the price, and the value, the return on your investment is 5%. So that's all fine. If you then buy a similar product and it costs 2%, but the return is 7%, then of course the second one offers better value than the first one. Even though the price is higher, the return is higher. So overall, the value is greater in the second example that I've just given than in the first. So oftentimes what you find is financial institutions who will lure you in at a low price. I'm not going to mention names for obvious reasons, but there's lots of them out there. Some of them, by the way, are excellent. If you can get a low price and it gives you great value, then that's the perfect combination, of course. But generally speaking, most people don't compare apples with apples. And again, what I mean by that is to compare two products in the same asset class, you don't have to just compare price, you have to compare returns as well. Because if you lock the two of them together and compare them directly, that's when you get a better assessment and you can form a better judgment of which one is the best.
That's where I guess emotion comes back in again as well, doesn't it, to some extent? So, the response to the 2%, 7% thing as a negative, which I think many people I know would think that, is clearly illogical. So if you turned around and said, well, the first return offers you 4% clear, the second one offers you 5%, which is better, but well, no, I'm paying you 2%.
Exactly.
It's the same thing. I thought about why people go to cheap accountants or poor advisors when they could go to better advisors. I've always felt very clear that anybody that came to me would at least have my advice pay for myself. Do you know what I mean?
I think that's
as a minimum.
Really good example, Paul. Why do people buy prestige vehicles? Because they last longer, they're more resilient, more robust, etc.
So welcome back. So come on, Sandro, hit us with your 6th tip.
Time warp. That was almost a lead into another song, Paul, but it's not on your list. The next one, I would say, utilize reliefs and exemptions. So, and this is a massive topic. I know we've only got a short time to just explore this briefly. And what we mean by reliefs and exemptions, I'll whiz through this as quickly as I can. Every single person in this country has a basic income tax relief. What that means is the first £12,570 that you earn, as long as it's earned income, is taxed at zero. And then we go up in little stages, in bands. 20%, 40%, and then 45% being the top rate of tax. Far too many people earn money but don't realise that they've got these exemptions. So if you're a married couple, for example, you can apportion some of your income to your wife or husband to utilise their exemption. We also have a £12,300 capital gains tax exemption. That means that we can make profit on things like property, stocks and shares of £12,300 before we pay any tax. Most people in this country don't fully utilise their capital gains tax exemption, as well you know. And then things like your individual savings account allowance, that allows you to ring fence £20,000 per tax year in a way that avoids things like income tax, capital gains tax. And then the one voluntary tax, as you know, Paul, inheritance tax or estate tax, as we sometimes refer to it. And basically, again, everyone has an exemption, £325,000. And if you are married, own your property or in a civil partnership, own your own property and have issue, natural heirs, then you have this other exemption called a residence nil rate band. So basically each person can have up to £500,000 of exemption before their heirs start paying tax at 40%. And then there's a whole bunch of other exemptions and reliefs, savings tax band. And if you bolt them all together and use them really, really effectively, you can earn a lot of money before you start paying tax.
Yeah, we've talked about inheritance tax before, haven't we? It's actually quite staggering. How many people don't really care about planning their affairs, often for quite selfish reasons?
Well, I think the starting point there is that most people have this misunderstanding that if they die, everything naturally passes to their wife or husband. And actually, that's not true. Because there is a hierarchy of things, as you know, when it comes to estate plan. So if somebody dies, usually the spouse will receive the first £275,000 of their estate, assuming the estate is worth at least £275,000, and only half of the balance. So if they've got children, the children will naturally inherit the other half. So you end up in this crazy situation where sometimes a wife or a husband who's recently widowed, for example, ends up joint owners of a property with son, daughter, family. 62% of the people in this country, Paul, don't have a will. And a will is simply an expression of wish that says, if something happens, this is what I want to see happen. And it causes chaos. I've got a good friend who is a contentious probate lawyer. He's never been busier because there are so many problems caused by people not writing wills.
What you must have come across this situation. What happens where, let's give an example of a person with a very big estate with no planning. They die, say it's worth £5 million. You've then got £1 million tax bill. Mm-hmm. There must be situations where estates simply can't afford to do that. So what happens?
Well, where the estate can't afford, and there's a great example actually, not many years ago, 10 probably, maybe a bit longer, I lose track of time, a gentleman by the name of Matthew Harding. He was then the owner of Chelsea Football Club.
I remember him, yeah.
And his family ended up with all sorts of financial problems because his assets had to be sold to pay a massive tax bill that no one had planned for. Lady Diana, as many people will know, another great example of a huge estate that created a massive tax liability, and the Inland Revenue unfortunately don't sit around waiting for their cash. They want it within 3 months typically. So the simple answer is you can either effect what's called a deed of variation up to 2 years after someone's death. You can reconfigure the estate for better tax consequences. You can insure the risk, take out an insurance policy to cover the tax that might be due. And there's a bunch of other things that we could talk about on another occasion.
So we are now on tip 7, Sandro. Sete.
Understand the value of money, Paul. I mentioned earlier, a loaf of bread in 1980 cost a lot less than it does today, and people overlook this. And the reason I've come up with this as a little tip for today is because, again, rather kind of relevant and topical at the moment. Inflation is spiraling out of control. That's putting pressure on interest rates. And what we know about the cost of living, inflation, as many of us refer to it as, it affects things, the prices of things. Now, when you're investing money, when you're trying to grow your wealth or build your assets, going back to that sort of 7% ideal outcome return on an investment or asset, what we're trying to achieve at all times is a rate of return on an asset that exceeds inflation and covers any income we might want to be taking. Because otherwise, the real value of that asset, commodity, or thing will reduce in time in price over time. So we need to always beat inflation in order to maintain the buying power of that particular asset. That's what we're talking about here.
Very good. I can't think of anything intelligent to say to that. We just look at you and say nothing.
It's honestly though, Paul, it's something that people overlook because they say, well, I'm happy in cash. Well, how much are you achieving in cash? 0.1%. Well, that's fine. Maybe for the short term, that's a good place to be. But, if you were sat on cash at 0.1% for 5 years and inflation was 5% a year for those 5 years, then the buying power of your money is going to be, just shy of 25% lower in 5 years than it is today.
Yeah, I think one of the problems with that, so I'm actually admitting this is me, for instance. One of the problems with, so I totally agreed with what you said about cash. In my case, I would probably go for at least a year, maybe more, in terms of what I would do. One of the problems with low interest rates is obviously there isn't an obvious home for your cash. Do you see what I mean?
There isn't, but then I took a lot of my own personal cash at the back end of, when we first heard about COVID and all of its potential implications in 2020. And it was April the 16th, I decided to put quite a lot of cash into the stock market. Now, that was a time when everyone was saying, you're absolutely mad. COVID is going to decimate stock markets for years to come. But of course, we've heard that 100 times before over the past sort of 20, 30 years. And in a very short space of time, just a little over 13 months, I made 117% return on that cash. So now, of course, the market's fallen off a little bit since then. But my view was always not to make a short-term gain, but to buy an asset that had a low price. And even if it took 5 years to realize a good return on that money, in any market conditions, even in recessions, throughout the whole of history, pretty much, there have always been some great investment opportunities. So you've got to find them out, really. So in recessionary times, not that we're in one now, but a lot of people are talking about that being a possibility. What most people will tend to do, Paul, is they'll tend to buy the blue chip stocks, the well capitalized,
safe ones.
Yeah, the low debt laden companies that are more likely to survive with some resilience through recessionary times. Conversely, when the market's growing, you probably leave those companies alone because they tend to grow slower. And that's when you tend to support the smaller companies, for example, because they're the ones that experience the most growth. So you've just really got to know where to look. But there's always an opportunity in any market conditions. Yeah,
one of the things that occurred to me, again, while I was thinking about what you were saying, is one of the things that I think most people don't have is they don't have a strategy. And another way of looking at it is understanding your own mind. So, for instance, with myself, one of the things I would say was good about me, is I do think about why I'm doing what I'm doing and think ahead and long-term plan. So at the minute, I would probably have a disproportionate amount of cash. Why do I do that? I do that because I feel vulnerable.
Yeah, that's a great. Going back to what I said earlier, there's no right or wrong here, Paul. Cash is a short-term strategy. Property is a long-term strategy. Stocks and shares might be a medium-term strategy, and the trick is to put certain amounts into different pots to meet different objectives over different timelines. That's the trick. I'm going to come up with this one, Paul, simply because you mentioned the word strategy just now. And what I've got for the listeners is the next tip, which is stick to the plan. And I know this sounds a really, really obvious one, but going back to what we said right at the beginning about making emotional decisions, people tend to almost tear up the plan when something goes wrong.
Yeah, agreed.
And they tend to lose confidence very, very quickly. But if they've made the decision for all the right reasons, so, part of my long-term, I'm 35 years of age, retirement's 30 years away, I can afford to take more risk, therefore I'm going to invest in property and stocks and shares, for example, the short-term blips don't matter. As long as all those decisions have been made for the right reasons and the 30-year plan is solid, stick that piece of paper, the contract note, whatever you want to call it, in a drawer, forget all about it. The shorter term stuff, yes, I agree that emotionally there's a bit more of attachment to those things. But if you don't stick to the plan, and honestly at the moment I've lost count the number of people in the last 4 to 6 weeks who have phoned me and said, do you think I should ... and the dot is, sell my investments, do this, do that. The answer is, just because the market is doing some peculiar things at the moment doesn't change the overall strategy. And that's a very, very important thing to keep checking and reminding yourself. Did I do it for the right reasons? If I did, there's no reason why it isn't as good today as it was yesterday.
Yeah, I think one of the things I talk about a lot in terms of attributes of business owners is having courage. And I guess that also, in a slightly different way, applies to investment strategy. Because it's obviously very easy when things are not going well just to sit there and say, right, I'm going to run for the hills, And it does take a degree of confidence, doesn't it, or courage.
Again, if you've made the decisions for the right reasons, you've thought it through, understand the pros and the cons. Again, linking back to what I said earlier, you understand and feel empowered around those decisions. The hardest decisions to make are the ones where you tend to react because you don't understand why you've done something. And that's why I've tried to take everyone through this logical process of selection, understand the reasons why you're doing it. And as long as you get those two bits right, it's easier to deal with the ups and downs of the world in which we live, which are always going to be a material part of our lives. Just a question of how often they come along.
Yeah. So, I mean, who knows what's going to happen at the moment? And I think I'm a great believer as well that you can only make decisions on the basis of what you reasonably know at a point in time.
Yeah, I think people call me sometimes expecting me to have a crystal ball. I've no idea
Haven't
what's
you?
around the corner. I wish. With great respect, neither you nor I would be sat here today speaking to these lovely regal purple microphones, would we, Paul, if we knew what was just around the corner. So the reality is we don't know what's around the corner. Fund managers don't know what's around the corner. Property developers don't. But as long as you have that well-diversified portfolio, make the decisions for the right reasons, you can afford to stick it out.
Okay. So that's the end of tip Otto, yes. No, it's too much. I've been practicing my Spanish recently, so my Italian, which is normally stronger than my Spanish, is slightly inferior at the moment.
I'll give you another tip, Paul. Norve is next.
We're on tip 9.
We are.
Nuevo.
Norve,
that's it.
Well, this one,
I give up.
This one's right up your street, Paul, because I'm going to. I'm this quid pro quo time because you've been very kind inviting me onto the show, and I think we're going to get.
It's your show, chap.
I know, but we're going to get lots of great stuff done this year together in the shows that follow. But in all seriousness, I also want to make everyone aware that in exactly the same way that I hope they would come to me for good advice, so they come to you for good advice. And so the tip number 9 is get good advice.
Yes.
Now, whether that's from an accountant or solicitor or a financial advisor or a bank manager
or a hairdresser
or a member of your family or a hairdresser, anybody that you like and you trust that is knowledgeable on their subject, get good advice and stick to that plan like glue. Follow what they say. To your earlier point, if you're going to pay somebody to do that, then follow that advice as long as you understand why you're doing it. But getting good advice should never be underestimated because many of us have spent decades plying our trade, learning everything there is to be learned, and going back to that price versus value point, there is a lot of value in getting really, really good advice.
Yeah, absolutely. I guess the other way of looking at it is if you don't feel like that, you've got the wrong advisor.
Yeah, absolutely. The whole likability thing and the trust factor, very important considerations when choosing the advisor you want to work with. And, don't be afraid that if you come across the wrong person, don't be afraid to try one or two others until you find somebody that you are prepared to work with. Because let's be honest, in the most part, a really good accountant, a really good financial advisor are people you're going to be working with for 10, 20, 30 years possibly. And there's every possibility as well that your kids will be working with them as well.
One of the things that so after too many years, 41 years in my profession, So you think you'd learn after that. Is I'm still staggered how many. So even friends of mine, clients that are friends of mine. I won't mention the names on the radio, but some well-known people, for instance, who will, for instance, use me for everything other than their accounts. And then if they want to talk about anything sensitive or important, they talk to me, but they won't change from their account if they don't want to upset them. Things like that. And, I just find that sort of very hard to understand, really, because it's like fudging it, isn't it?
Yeah, again, I come across that as well. Look, I'm all for second opinions. Sometimes you want to ask another professional for an opinion based on advice you've received. I'll give you an example. A very large direct sales investment company that have American origins. That's all I'm going to say. We're talking to a prospective client who contacted me and said, I've got this very large pension fund. It was close to £1 million. And he said, they've told me that something called lifestyle planning, which is basically the disinvestment from risky assets over the last 5 years before you retire, is not a good idea. And I said, why would that not be the case? And they said, well, because what they're saying is by investing with this particular company and by remaining invested in equities, they can make more money in the last 5 years before they retire. And I said, well, that's all fine until, of course, the stock market suddenly drops by 10 or 20% in the last year before they retire. So the logic of what they were being told, advice-wise, was irresponsible in the extreme. What that doesn't mean that everybody should do this lifestyle planning where they disinvest, because that's not for everybody, for reasons we discussed earlier. But proactive advice, sticking with somebody and reviewing the situation, objectives, and your current situation every single year, that's the way to make money in the safest possible environment.
Yeah, and I think somebody who knows you and your circumstances and what your attitude to risk is, for instance, is very important. This is our final tip for today. Number 10.
Number 10. No excuses for leaving this one to last. Take action. Once you've decided on a plan, once you've found the right advisors to support you, make a decision. And the reason I mention that, Paul, is that it's extraordinary the number of people who procrastinate, where they are confronted with this myriad of different choices and options, and then they end up getting stuck in no man's land. And what I do by way of an example is I say to people, there are, broadly speaking, two different kinds of people. Person number one is the person who invests and then sees the value of their investment fall and feels really bad about it. That's a natural human reaction, of course. And then there's those who do absolutely nothing and then see everyone else make lots of money and feel really bad about it. So what we're saying here is that really, whichever one of the two choices you make, you are going to be disappointed at various points along the way. But as long as you take that long-term strategy and you've researched it and you've got good support and advice and you understand the reasons why you're doing it, then taking action now is better than taking action at some point in the future, because as a general rule, you make more money the longer you are invested in an asset, because what you do over time is smooth out the peaks and the troughs of that particular asset class, and they all go up and down in value. Even cash, because as we've heard before, cash is affected by inflation.
Of course.
And stocks and shares go up, so do property, so does gold, so do oil prices, nickel, as we mentioned earlier on. So everything goes up and down in value. But just understand that it is about time in an asset rather than the timing of the purchase of that asset.
Yeah, I mean, one thing, I actually went on a lecture to do with this. If you take, you'll know this, I'm sure, if you take the stock market since 1900, there is no individual period of 10 years where the market was lower at the end of the 10 years than it was at the beginning. So despite everything that happened, including the great crash in 1929 or whatever it was, or 27, it's still, so if you take the 10-year term, which is exactly exemplifying what you're saying.
Yeah.
So take the long-term view, accept that. That's why, so a bit of a self-plug. So my second book, I called it Winning 2-1, which is very much all about that. Life is not about winning 2-0. You march forward and then you get kicked in the whatevers and you march back a bit. And as long as you can keep going, you go 2 feet back and you lose 1, then you're net winning.
Well, look, everyone remembers, I guess everyone listening to this today remembers 2008, 2009. If you take a 1-year snapshot, you see a massive dip in performance. If you stretch it over 10 years, it's a tiny little mark on a bigger graph. So
we've done too much talking for today, Sandro. So thank you very much for the first Financial Forte with Sandro.
Pleasure, Paul.